So we're very, very excited to talk about the topic and also have CPA Joel Jensen with us, um, an expert at income tax planning, a strategist, and and to talk about just simple things that we can do. We don't have to have a huge accounting firm and the best CPA in the nation. Sometimes it's simply a mindset for our students. But before we get into taxes, let me go through just a couple little housekeeping items. If you're brand new to us, especially if you're coming in from Tax Hive, welcome. We appreciate you being here. This is a long running asset protection class. We've taught a lot of different topics over this year and a lot more to talk about. We've we've had Scott Estel, former senior trial attorney from the IRS here. We've talked about valuations. We've talked about estate planning, avoiding lawsuits through mediation. We've talked about cost segregation, grants and loans, and making money with the stock market. We've got a lot more to do, and this will be a busy summer for us. So if you're just joining us, welcome to the series. We don't teach every Tuesday night, but probably 2 or 3 weeks, Tuesdays a month. And so watch for your emails. These are all recorded. If you'd like copies of any of these, well, not copies, but recordings of these, you go to Protect Wealth. You can do it now, just don't log off on what we're doing here. You would go to YouTube and type in YouTube, open a different window, don't log off, um, pull up Protect Wealth Academy, and then hit subscribe, and then you'll have access to all the webinars that we've done and future ones as well. All right, we've got 3 upcoming summits. One is in Orlando. It'll be a live event. It'll be our first live event since COVID hit, so we're really excited about that one. And that one, registration is going to fill up. And this is not a little game. We will cut off registration when we meet our maximum of room capacity. And that one, we're probably looking for registration within the next couple of weeks. If you're coming to that, we've got a beautiful hotel. It's at the Omni Orlando. It's a beautiful 5-star, 5-diamond hotel, and we got a really good rate. So it's a Disney property on Disneyland, and so then there'll be a live stream event. This is a Zoom event in October and another live event in November. So there's our calendar. If you'd like to register, you'd go to protectwealth.com. And on that website, you can also see it's a very, very robust agenda. We cover a lot of ground in 3 days. In fact, for CPAs, for attorneys, for professionals, they generally get continuing education credit. It's that good, but it's really for business owners, it's for real estate investors. We're going to cover how to protect your assets, and we're going to cover it very well. So, and then there is a weekly just open Q&A every Thursday. If you'd like an invite to that you log on and just ask questions, and we get through as many as we can get through in a half an hour. And so if for invite, like us on Facebook. You don't have to like us, just whether you like us or not, it's irrelevant. Connect with us on Facebook, and you'll have those invites. And then finally, before we get started, legal and tax, we cannot give legal advice or specific tax advice to anyone. We're going to teach general principles tonight and how that affects you. We're going to invite you to a free consultation and see whether some of these tax savings ideas will apply to you and your situation. But don't take everything across the board and go, oh, I can do it. May not apply to you in your situation, but seek a professional in all things tax wise. And so with that, I'm going to turn the time over to Joel and tell you, Joel, we're so excited to have him and his credibility. I've gone through his slides, and I really long-term believe that the way to reduce our taxes is not necessarily to get a smarter, better CPA. It's about becoming involved. It's about being active and becoming educated in the tax system. We appreciate all of you being here. Thank you for being here, and thank you for your time. We're going to let Joel kind of go through his presentation. I've gone through it. It looks really good. It's very well organized to be able to answer most of your questions. However, at the end, there'll be lots of time for Q&A. So save up your questions, and you're going to put those in the Q&A screen, not in the chat screen. But when that time comes, so write down your questions for now, and then we'll answer them as we get further along in the presentation. Joel, happy to have you. Thank you for your time. We appreciate you being here.
Thank you. All right, so I'm going to share my screen here. And all right, I think we got it. And we can start, let's start going through it. So welcome to Tax Strategies. My name is Joel Jensen. Happy to be here. Happy to talk to you a little bit about some of the experiences I've had over the last little while, let's say even this year, to try and maybe change your attitude in the way that you not only view taxation, but a little bit maybe on even how you run your particular business. Now, I know we just talked about the tax notice about everyone not being clients. So this is general information. So I'm just going to skip that. And I like to start these out with giving you a little quick reference, so to speak. Just a few little items that I've noticed pop up here and there that I think you should know about kind of currently, as in today. So remember that we have tax deadlines that are still coming up for those who extended September 15th for entities, October 15th for your personal tax return. They are not the same date. That changed back a few years ago, so just be aware of that. Also would like to make you aware if you have filed your tax return and you haven't gotten your refund, simply be aware that the IRS and all the wonderful work that they do, you can sense my sarcasm in that, but there are 20 million roughly tax returns behind. And so it's taking them longer to process. Largely, I think this is due to COVID and the result of kind of the environment of people having to work from home, including them, as well as the stimulus payments running through the IRS. A bunch of these things have kind of formed together to put them behind. Also, because they're behind, but like what happens every year is the wonderful scammers come out with their various scams to try to trick you into giving information. So if you got a PPP loan and you get an email or a phone call regarding give us your information because we can help you through forgiveness, know that that's likely a scam. It should come through the provider or through your portal login where you obtain that loan. Never send Social Security through email if people ask for that, and the IRS will never call you. Okay, they will not call you unless you have a preset appointment with a specific person that you had already been communicating with. So if someone calls you, says they're from the IRS, just simply know they are not. And even I get some of those phone calls. And while I have never actually pressed one or gone through the little recording that they do in the beginning to talk to me about my my personal tax situation, I am oh so tempted every time that I get one. So be aware of that. It's not from the IRS. And finally, if you have not yet filed your tax return, or even if you have, and you were unaware that there are lots of tax credits related to self-employed individuals and COVID-19, or whether you had it or had to take care of someone that did, and it resulted or impacted negatively towards your ability to work, know that there are credits out there that you should be visiting or revisiting if you didn't submit those through your tax return the first time. Okay, so let's get into the kind of the meat, so to speak, of what I want to talk about. And I'd like to start here. Okay, I like to talk about you and your business before we talk about taxes, because I think one of the biggest mistakes business owners make is not knowing or understanding your financial situation, your financial statements. Let's just call it your numbers. What are your numbers? Do you understand your numbers? Do you know what they are? So if I were to meet with you and I said, hey, what were your sales the first quarter of this year? Could you answer that question? Or what is your net income to date? Or how much cash are you earning? Do you ever watch Shark Tank? So I like to watch Shark Tank. I think it's interesting because I always like to hear the questions that they're asking the business owner. Because to me, That's the most telling aspect of all of it, because it's a critical kind of examination, outward looking in, of what they think is happening with this business. And within the first, maybe let's call it 2 questions, you're going to get someone that's going to say, hey, how much revenue? How much does it cost to make this particular product? Why? Because they need to understand and know that you, as a business owner, are vested in what you're doing. And Don brought that up in the beginning. That is one of the singular most important things from a taxation, even from a taxation standpoint, that you can do for your particular business, is to be vested in what it is that you are doing. Just like you are here right now, listening to me, which I appreciate, but that just shows that you are vested in what you are doing. Okay, so know your numbers. Don't make that one of the biggest mistakes that you can make from a tax standpoint is not knowing your numbers. Because I can tell you this: if you don't care about it, then I don't care about it, right? So if I'm your tax preparer and you don't care about your numbers, I mean, how much should I really care about those numbers? But if you come in and you are vested and you sit down and say, here are my numbers, this is what happened, let's talk about it, and let's make some tax plans to save me money. Oh, I am all in on that, right? I'm all in on that. Okay, so some solutions to what we just talked about. Make sure you are reconciling your bank statement every month. Now, I know this can be tedious, but it's just one of the things we need to do as business owners. Understand where revenue is coming from, what kind of clients I have, what are they buying, what am I able to purchase and resell, what are my cost structure. Understand the movement of cash. And this is why I really went into accounting in the first place. I love cash, right? Love cash. And I love the movement of money. If you were to present to me your financial statement, so I looked at your balance sheet and your income statement, for example, and I start going over it, examining it, what I am doing is I am building a story. I'm building a story about you and your business. How did the money get there? What did you do with the money while you had it? And then how did it exit the business? It tells me a lot about your company, your particular situation, how you manage things. It's the story that I absolutely love. And I love talking to my clients about it. The story of cash within your particular business. Okay, so just look at some of these solutions and let's take pride in being on top of our business and the numbers of our business. And I like to use this example as well between the chef and the business owner. So I like to cook. Okay, it's one of my hobbies. So if I'm not here, usually I'm either outside doing some sort of activity or I'm in the kitchen cooking. And I'm one of those people that will, spend 20 hours researching a knife, so to speak, about, when I want to buy a knife and the type of knife it is and where it comes from and how it's made and the steel, is it folded and all these types of things. And so I'm examining that. So that gives you a little glimpse into my personality. Okay, but the chef and the business owner are totally different. The chef is worried about, let's say, the food, the recipe, the daily specials, how people review him, how the critics like him, his reputation, right? So he's really just focused on the food and the delivery of that food and the experience that that food gives a specific client. The business owner or the restaurant owner, so to speak, is also concerned about that, but so much more. I'm concerned about rent. I'm concerned about the cost of food, my overhead, my cash flow, how many people are coming in, how long does it take for them to turn a table, so to speak, because that's how I make most of my money. When should I be open? What hours should I be closed? What makes the most sense? Should I expand to multiple locations? As the business owner, I'm looking at the whole world around me. So that's what I want you to do. Well, it's great to be a chef. It's great to be the chef and the owner. It gives you a different perspective of your particular business. Okay, so let's start with the taxes. Here are just our tax rates. Now, I know that you can look at this and simply say that, Joel, this is the most boring, the boring thing I've ever looked at. I know there are tax rates, so what? I don't care. Well, you should care. And I'm going to change your mindset on why you should care. Okay, on why you should care. Now, I love cars as well, right? Cooking and cars, they kind of, go together. That's why I probably love Sprinter van and camper vans, but I love cars and cooking. So let's take this, for example. So let's say that for whatever reason, I was able to purchase this wonderful Ferrari for $200,000. Why did I purchase it for $200,000? because I knew that I could sell it for $300,000 on the back end. It's kind of like doing a wholesale deal in real estate. I don't know if you're doing real estate. It's kind of that same kind of methodology. I'm going to buy something, I'm going to turn around and resell it and make a margin on the purchase and the sale, and that's how I'm going to make my money. So let's say I bought it for $200,000, sold it for $300,000. I made $100,000 worth of money. Okay, $100,000 worth of profit, so to speak. Now, is that what I really made? Was that $100,000? Is that how much money I get to put into my bank account, turn around, maybe go buy a boat, maybe go buy a mountain bike, maybe buy some new furniture for my house, maybe, I don't know, take a great vacation? Is that what I get to spend on all my personal items? Is that $100,000? Or do I have this invisible partner, so to speak, who sits on my shoulder and taps me on it every time I make money and holds out his hand and says, pay me because I deserve a portion? That's the IRS. They are the invisible partner that we have in every little thing that we do, even when we are employed or an employee of someone else. And if you don't believe me, take a look at your paycheck, look at your wonderful withholdings, and then tell me you don't have a partner even when you're employed by someone else, because we do. So understanding my tax rate, let's say effectively 20% to make the math easy on the accountant. So if I made that $100,000, I may effectively owe $20,000 to the government. So really I'm looking at $80,000 to either spend on my vacation, spend on that furniture, spend on that mountain bike. And I always have to be aware of that, because that's where people can get into trouble. Well, they don't understand, hey, I'm making money. I'm not going to set anything aside because, let's be honest, it's way more fun to take a vacation, right? And I get it, and I totally understand it. But then that can kind of create the snowball effect where you get really behind, and it's a hard kind of hill to climb if you kind of find yourself in that predicament. So just be aware, when I make money, understanding my tax rate gives me an idea of how much I may want to put aside and pay taxes on the portion that I'm making. Now, here's the important part. Conversely, what happens when I spend money? What happens when I spend money? So recently I bought an iPad Pro. I love technology. I think it's really fun. I buy stuff I don't even need. My wife tells me that I have a problem. I think it's cool. Even if I'm going to look at it, I'm probably going to figure out a way to purchase it. But recently I bought an iPad Pro. Cost about $1,649, right? Plus the Apple Care. Let's call it $1,800 for that. Now, the problem with Apple products, as we all know, is they rarely go on sale. Rarely. Maybe it's because a new model is coming in, or maybe you find something at Costco, cross your fingers, gives you, 10 or 15 bucks off. But typically, no matter where you go, the cost is going to be the same. So Apple doesn't put it on sale. But if I'm using it for my business, which I am, then guess what? That wonderful partner that sat there that took the 20% is now going to contribute the 20%, allowing me to deduct that item on my taxes and pay less in tax, right? So when I'm making money, I got to give a portion, but when I am spending money for my business, everything is on sale. Why? Because I get it deducted. That's why there is always the fourth quarter spending spree for all businesses that make money, because you're looking at ways to safeguard those dollars by spending those dollars in things that will actually produce even more revenue the next year. So why Apple doesn't put it on discount, the IRS does. So keep that in mind. Look at your mindset when it comes to money I make and the purchasing power of business assets. Now, the funny thing is the IRS views tax changes, well, maybe a little bit differently than you and I. So we had this change that happened back in 2018, right? And actually it was let's call it the end of 17, but it affected our 2018 tax year. Now we might be headed into another one of those fairly soon as well, right? We hear all the rumblings in the news about changes that may or may not happen. I always call it the wish list of kind of tax changes. Maybe it's this big and maybe what they actually pass is this much. I mean, that's typically how the negotiations work. But, it's probably, I'm going to say, a safe bet to say that there are changes that we will see in the near future. So how does the IRS view these changes? Well, it's an odd thing because they view it a little bit differently than maybe you and I would do. And I'm going to give you an example. So I was in California when the last tax changes occurred, and I was on vacation. It was in December. I got a phone call from a client of mine who is a real estate person who lives back in the Midwest. And he called me to say, Joel, listen, I've been looking over these tax changes and I have a brilliant idea. So, hey, brilliant idea. I want to hear that brilliant idea, right? So what he said was, I'm going to prepay all of my property taxes, right? I'm going to prepay them. Why? Because they have this $10,000 cap that's going into effect next year. And I'm fairly certain that my property taxes, along with any state tax withholdings that I have, are going to shoot past that $10,000. So while I can't deduct it, I'm going to pay it in 2017. So we had a conversation. I say conversation because he's probably going to say we had an argument, right? But we had a conversation about this very issue. And at the end of this argument, he decided that, okay, fine, I'm not going to pay it. I'm just going to wait and pay it normally like I typically would. Now, this was in the news because a lot of people were doing it. And then I noticed about 2 weeks later, the IRS came out with a little notice. And what the IRS said that, and they love to use words, by the way, words to their advantage. So they said, unless the property tax has been assessed, you cannot deduct it on your tax return, even if you prepay it, right? Now, when do states typically assess property tax? Well, unless you're in California, I realize that's a split year, and we have a couple others that work like that. But most states operate and they will assess it in the year you pay it. So you pay it in the year that you assess it, that's assessed, and therefore the IRS lets you deduct it. But had my client prepaid it in 17, he wouldn't have been able to deduct it in 17 because it hadn't been assessed. And then 18 rolls around when it was assessed. And since he can't pay it again, because it was essentially a credit, right? He wouldn't get it in 18 either. So that's what I call dead money, dead tax money. Man, I hate dead tax money. That's like the worst thing from a CPA standpoint. But that's how the IRS does. That's what they do. They look at changes. They use words to their advantage in order for us, to have to reevaluate maybe how we do a specific tax return. But what we end up doing from a tax preparer standpoint is we wait for these notices. We look for those notices. We look for clues and kind of as the IRS rolls around to getting to resolving specific issues to the new tax code on how they're being treated. And then we kind of apply that within the tax return to help our specific clients. Now, let me give you this little beauty. This is what we call the qualified business income deduction. I call it simply the QBID for short. But what that does is that establishes a 20% discount on the active income that we make. I'm going to give you an example right here. So let's say, and by the way, this is part of the new tax code. And what I'm hearing is this is not one of those topics that they're maybe taking away moving forward. So this may be here to stay. Let's cross our fingers. Maybe they adjust the income limits. Let's cross our fingers that this stays because it's a beautiful deduction for our self-employed individuals. So me as a CPA, okay, I'll give you the example as me. So let's say that last year I made $150,000. So I brought in $150,000 for the services that I provided for my clients. In order for me to provide those services, it cost me $50,000, leaving taxable income of $100,000. Now the QBID, the wonderful, beautiful little QBID that I didn't have to do anything to get, simply goes in there and says, okay, $100,000 times 20%, I'm going to give you a 20% reduction, and I'm only going to tax you on $80,000. Beautiful. I love paying less in tax. In fact, I love getting deductions that I don't have to pay for. I mean, those are the best, right? So, but it's a 20% reduction. Now, the issue with this particular tax regulation or code was that it was new. Okay. It was new to preparers, new to business owners, and it was, let's say, difficult to know how to apply in those first years. By now, 2020, everyone has a kind of a good handle on what to do when it comes to the QBID. But in 2018, we did not. In 2019, it got a little bit better. So what I'm going to suggest to you is that if you have self-employed dollars, okay, I was self-employed in 2018 and 19, I made money. I'm going to say, take a 10-minute exercise, go back and look at those 2 years worth of tax returns. This QBID is its own singular line item in the 1040. Okay, so if I had money, if I had profit, and that is left blank, it was probably missed. And it was missed more often than I would even like to admit. Okay, so go back, see if you're due money. You can still amend 18 and 19, even if you've already filed 20, and go back and get those dollars that are due to you. Okay, that are due to you. So take that quick little example, quick little exercise, and let's make sure that you haven't overpaid the IRS. Okay, I also want to just briefly talk about this home office deduction. Now, I know everyone's heard of it. There's nothing new at all, actually. But I go through, tell you a little bit more about my personality, right? 20 hours to look at a knife. I also go through and I look at IRS stats, okay? Because they do post stats on what they're seeing from a tax return standpoint. Now, granted, they're usually a year or two behind. So, we got to get through a year, then take another year, and then kind of the real numbers start coming out. But I was looking at the home office deduction and how many people actually took it. And then for business owners, right? And it was ridiculously small. I'm talking less than 20% of individuals actually took the home office deduction. What happened in 2020, right? The whole landscape of how we worked, where we worked, completely changed. And this is why I bring it up. Because many of us who were self-employed, maybe we were in an office, like even in our CPA firm and practice here, while last year, half the workforce was now working from home. And that brings in this home office deduction back into play. So I would expect many of you who are self-employed and then had to start working from home are going to start using the home office deduction. Now, there's two ways to do it. We have the traditional method and the simplified home office method. The traditional method is kind of probably what people think about when they talk about the home office. I'm going to look at my square footage of my office versus my entire house. And then whatever that ratio is or percent, let's say it's 5% or 10%. And then I'm going to deduct 10% of the indirect costs like electricity and my insurance and property taxes and maybe my mortgage interest, those types of things. And that's going to give you my home office deduction. There's a kicker to this side, because what it also forces us to do is to depreciate the value of that 10% of my home. So let's say I've lived in Newport Coast, California, in 1,000 square foot home, and it cost me $1 million to buy, and my home office was 100 square feet, right? So that would be $100,000, right? 10% of that million. I would start depreciating that $100,000. So I'm converting personal property to business use property. From one hand, it's great. I get an additional deduction within my home office to decrease whatever tax that I may owe. The bad side is when I go and looking at home values in 2021, and I say, wow, that $1 million for that 1,000 square feet is now $2 million for that 1,000 square feet. I'm selling this thing and I'm moving to Montana, right? So I sell it, and there's that wonderful depreciation that I've been having in my home office, and all that stuff just comes right back in income, and I got to recapture it and pay 25% tax on it. So just be aware that there is a back end kind of penalty, if you will, that I have to be willing to pay if I'm using the traditional home office. So what the IRS did a few years ago is they came out with this simplified method, which simply says $5 per square foot up to 300 square feet for a $1,500 deduction. I don't have to track utilities or insurance or taxes, or I don't have to depreciate anything. I can just get up to a $1,500 deduction on my tax return. So what I'm going to suggest to you is, I love the simplified home office method, unless I'm renting, by the way. If I'm renting, traditional works better. I'll just throw that out there real quick. But I love the simplified home office. If I own it, it gives me an extra $1,500, put some money back in my pocket, $300-$400, depending on what tax rate you're in. And you can go use that, I don't know, go have a great meal or something somewhere. Enjoy an evening, right? So just remember that this home office deduction, especially because of COVID last year, should be in play, and you should be talking to whoever your tax preparer is about whether or not this can apply to you. Because I'm also going to talk about automobiles, because I told you in the beginning, I love automobiles. That's why we use the Ferrari in that example of making some money. And people, it's surprising to me that this would seem kind of so obvious from a business expense standpoint, how many people simply just leave it out of when we're starting to compile all the expenses that go into a specific business. Okay, so just remember that if I'm using my automobile for business, or its usage is for business, then I have the opportunity to deduct it. Now we can do it in two different ways. We have the mileage method and the actual method. The mileage method is super easy. Every year the IRS posts cents per mile deduction that you drive for business. So if I drove 10,000 miles for business, 56 cents per mile, $5,600 deduction, boom, simple, goes into my tax return, really, really easy. The actual method is a little more complicated, okay? Meaning that I actually have to look at the actual expenses of my car, which mean gas, insurance, repairs, maintenance, brakes, oil changes, those cool carbon fiber bits and pieces you're gonna stick on your car, the smelly little trees that you put and hang from your rearview mirror, and all those things that go into your car. I'm going to track all that. Then I'm going to apply my business use ratio, which basically says if I drove 5,000 miles for business of 10,000 miles total, it's 50%. Apply that to that big clump of money that I spent on my car, and boom, that's my deduction. So the normal question would be, Joel, which one's better? And in my typical CPA humorless persona, I will say it depends, because it does depend. Depends on how you use your car. What type of car do you drive? How big is your commuting area? How are you utilizing the vehicle, right? It really does depend, and it's not the same for everyone. I will say that out of all the tax returns I do or see or review or look at, probably a good 75+% use the mileage method. Yeah, I will say that there typically has to be a case for actual, but actual can be so beautiful. From an actual method is like candy for someone like me, right? Because there's so many things I can do with it, especially if it's a heavy vehicle like SUVs or trucks, anything over 6,000 pounds. The current rules let me just deduct, 100% of my business use in the year that I buy it or put it into service, right? So there are times where the actual method can make a whole lot of sense. So from from your perspective, being the business owner's perspective, what is my job to do when it comes to automobiles? Your job is to track how you use that car. Now I know everyone uses something to track every mile that you take, right? Are you using an app? Or you're writing it down in your little notepad? What are you doing? I'm sure, well, I say that sarcastically because I know no one typically does. Usually if I'm talking to someone, it's like 5% of the people actually track it. And I get it. It's such a pain. Oh my gosh. It's like, it's one of the worst things and no one wants to do it. You do it great for a week and then you say, I'm out, right? So if you're out, does that mean you can't deduct it on your tax return then because you don't have the documentation to support how you drove the car? Oh, that's a question, right? So my answer to you would be yes, still deduct it. Okay, still deduct it. Estimate it if you have to, because the time when you would have to support it is under audit, and then there are ways that we can go back and try to recreate how you drove that vehicle, and that's the extreme circumstance. My recommendation from all of us CPAs is please keep track of your miles. But if you didn't, I would still recommend that you deduct the miles, and then we can talk about different ways of doing that, or you can talk through that with your particular tax provider. Okay, I want to bring up this one code section for you, which is code section 162. And I'm going to talk to you a little bit about an audit really quickly, kind of as I explain this. So I have a neighbor who is he's a landscaper. He does these really high-end landscaping jobs. I wish he could come do my yard because he's amazing at it. And he was, telling me all the different job sites that he's working on at the moment. It's the CEO of this and the CEO of that, and all these kinds of, high-end managerial individuals. But he had gotten audited a few years back. And if someone who knows me, or he knows a neighbor who lives around me, if they get audited, or if I hear about it through the grapevine that someone's getting audited, I just kind of sit back and wait, kind of like this. Because I know I'm going to get that doorbell ring, knock on the door. He's going to come over at some point because he's going to want to talk to me about, the issues of what's going on through his audit and how can he better prepare or document something. But he's going to talk to me about it. And in this particular case, he wanted to talk to me about backhoes. Now, he has numerous backhoes because he does kind of these big landscaping jobs. But the IRS auditor, as this person was reviewing all of his assets that he owned as part of the business, remarked that, it is neither ordinary or necessary for you to have multiple back O's, so I want to disallow one of them. Now, I am not aware of whether or not this particular individual had a background in landscaping or had ever even run a business, but that was their attitude when it came to ordinary and necessary. So he was explaining this to me. Now it got passed and it was allowed and everything was fine, but that's just the obstacle, if you will, when it comes to ordinary and necessary, because there's no great definition for it. I've been looking for a good one for 20 years, still haven't come up with one, still searching for one. Maybe you can email one over if you have a great one. But everyone's circumstances are so different that what may be ordinary and necessary for you may not be ordinary or neither necessary for me, depending on the type of job that I do. So when I'm going in and I'm looking at the expenses of my company, I'm really going to examine things. Okay, I'm going to look at my incomes, my bank statements, which, the checks and debit charges that I ran through there, my business credit card statements, personal credit card statements. Then I got to start looking at the apps. We pay so much through apps now, Venmo or Cash App. Those things were never typically made for businesses. They were made to transfer money personally. However, it became so easy that now a lot of people are using it for businesses. And by the way, on Venmo, you can create a business profile, just in case you didn't know that. So they're kind of getting up to date with its usage. But I got to look through all those things. I got to see and I got to examine how I spent money and what went around my ability to make $1. Because that's how I would define ordinary and necessary. What within my ability to make $1? Now, I like this slide because I think it puts things into perspective, and it puts things into perspective at kind of that 10,000 foot level that people can kind of grab onto and kind of hold and kind of examine within your own personal business and the way that you operate it. So if you were to ask me, hey, Joel, give me just 3 real quick ways of reducing my taxes, kind of a 10,000 foot view, I'm going to say defer it, spend it, or connect it. Those are 3 quick ways when you examine how you're operating your business of ways to reduce your particular tax situation. What do I mean by defer it? What I mean is utilizing those 401k plans, retirement plans that we have access to when we have self-employed money, right? So if I have a solo 401k, so if I'm a business owner, let's say I'm a single business owner, whether I'm a single member LLC or just a sole proprietor, I can set up what is known as a solo 401k. And depending on my age, I can put away upwards of $60,000 to $63,000 if I have enough income per year, which means that I get an immediate $62,000 to $63,000 deduction on my tax return. So again, let's say, $60,000, 20% tax bracket, you can add up to what that savings could be. And on top of that, that savings is also an instant return to the money I put into the investment because it's pre-tax money. So my ability to defer income for later use and take that deduction now is a super powerful way of reducing my taxes. Okay, also spending it. Now I know that seems kind of maybe ironic, but yes, when I spend money, I create deductions. Now we talked about at the beginning about that iPad, right? I bought something for my business. I was able to deduct it, and therefore it reduced the amount of tax that I could owe. But spending it, the idea of spending money, because you got to spend it to make it, right? Is that the idea is to produce revenue in the future. So let's say I had a banner year. Like my business is just taking off. I had a banner year, real estate wise, or whatever it is that I'm doing, if I'm selling online, or whatever the case may be. Had a banner year. I'm approaching November, December. That's why I call it the fourth quarter spending spree. So I'm going to look at what does my business need? What assets do I need? Do I need a new computer, monitors? Do I need lights? Do I need equipment in order to do Zoom, for example, like a microphone and lights and a camera and so forth? Do I need big equipment, for example? Do I need, there's a myriad of things that you could need. Do I need to buy a website and put money into that and develop it? Because the idea is as I spend money, it's going to produce money in the next year, but I get the benefit in the year that I spend it. That's why, again, if we go back to the very beginning of knowing your numbers, why it becomes so crucial for you when it comes to spending, right? to know where you're at, how much you can spend, and what kind of savings can come as a result of that spending. I'll give you another quick example. So I think I may have mentioned maybe before we got on here that I'm a real estate investor as well. I love real estate. I have commercial, I do flips. I can't always do it because usually I'm right here in front of this screen doing taxes and talking with clients. So I work with a various group of people, but we went and looked at a house where we were going to flip, which is an active type of operation. Looked at how much money was going to go into it, and looked at all the various problems that could go into it. We knew exactly how much money I had to spend on that particular project. Well, it turned out that the issues with the home would mean that I would overspend on its value. So we had to end up on the, 13th hour walking away from the deal. But before I spent it, I knew my numbers. So that's how that whole thing kind of comes full circle. I know my numbers, I know what I can spend, and I know the revenue I'm going to try to produce from that spending. And finally, connecting it. And I don't know if you've been to this area. So I'm located in Utah. I'm kind of south of Salt Lake City. It's what we call Northern Utah County. And at what we call the point of the mountain, which isn't too far from here, we have this beautiful Adobe building. Adobe built it. It kind of sits on this hill. It's elevated. It's all this glass building, and it overlooks the lake and the mountains. I mean, it's absolutely beautiful. So let's say that I was employed at Adobe. That was my job. I love it. Love my job. I get paid well. Benefits are great. Love the people I work with. Cafeteria just reopened because of COVID. Now I can go to the gym again. So it's even fantastic that gym is on premise, right? So I love what I do. I have no interest of leaving. I figure, you know what? I'm 50 some odd years old. I'm going to retire there. And that's what I want to do, which is great. I mean, I just want people to be happy is kind of the end is what I want. But what are you going to have or own in this particular case? Are you still going to own a car? Yeah. Are you still going to have, let's say, an iPhone? Well, maybe you have an Android, but let's just call it an iPhone because that's what I'm looking at. Are you going to have iPads or tablets? Are you going to have computers at your home? Are you going to have office supplies? Are you still going to go out to meals? There's lots of different things you're still going to have, whether or not you're self-employed or employed. Okay. But if I'm self-employed, regardless of the size of the business, if I'm self-employed, just the magnitude of things that now that it opens up from an expense standpoint. So what am I connecting? I'm connecting all these personal things over to my business. I'm using them inside my business. And now I get a deduction for it. The car that I would have owned anyway, I'm now deducting part of it. The tablet that I would have owned anyway, I'm getting a deduction for it. The phone that I would have owned anyway, I'm getting a deduction for it. So you can see where this goes. So to the extent that I can start to connect all of these personal expenses that I have and start utilizing those for my business, well, now I get a nice little tax deduction. Okay, so defer it, spend it, connect it, look at those and examine ways of how you can employ those three concepts into your particular business and save some money. Okay, I want to talk about kind of team stacking, maximum effort, kind of the Deadpool aspect of any business, actually. So when I left Ernst & Young, I was there for about 10 years. And it was a great job. Loved it. I mean, I feel like an Ernst & Young alumni. I have a certain amount of, kind of tie with them and alumni pride, so to speak, when it comes to meeting individuals who work there as well. So it was a great time to be there. And I also thought when I left and started the firm, I would kind of lived in a bubble, so to speak. I thought, oh man, I'm an accountant. I know numbers. I know what I'm doing. This is going to be a breeze. So started the firm, and I don't want to date myself, but it was kind of back in the day when I thought, oh, I'm going to build my own computer instead of buy it from Dell because I can save $200. Right? It's the accountant in me. I'm always trying to save. My wife calls me cheap. I just say that I'm prudent. So I'm going to save $200. I'm going to build all $200 per machine. I'm going to build them all. So that's what I did, which then led me to building a server, which then led me to trying to build my own phone system, which then led me to try to build my own website. And by the way, that was the most horrific disaster you have ever seen, right? But it led me to do all these things. So let's say we get into busy season and I'm working away, 12, 14 hours a day, trying to deal with all of my clients, and a computer breaks down. Phone's going to ring. Joel, computer broke down. Come down here and fix it. So then I got to step away. I spend the next 2 hours, 3 hours trying to fix this computer, finally, figure it out, get it back up and running again. Then I get back to my work and start working away. What was I not doing those 2 to 3 hours? I wasn't processing. I wasn't planning. I wasn't doing tax compliance, right? Tax returns and so forth. I wasn't billing anyone for those 3 hours. And those 3 hours happened this day. And then another 3 hours happened 2 days later. Another 4 hours happened the next day. Because anytime anything would break, people would call me and I would have to deal with it. And then all I could see is my revenue going like this and then shrinking and then shrinking and then shrinking and then shrinking. Right. So I had to take a hard look at myself and how I was operating the firm in the beginning to say, is this really the most efficient way to do it? Turns out it was not. So I like the concept of team stacking. Okay, a lot and somewhat of what you're doing right now, dealing with the organization and how you're going about getting information operating your business. So now I have an IT department that deals with anything electronic. I don't want to touch it. And I have a phone system, company that deals with anything phone-wise. I don't want to touch it. And then I have website people and I have lawyers and I have all these people that deal with everything else. I don't want to deal with it. Because what I want to deal with is helping my clients save money, deal with tax compliance and tax planning. That's what I want to help with. Why? Because that's also how I bill. It's also how I make my money. So if I'm not billing, I'm not making money, right? So I team stack all these different people in place that will allow me to maximize what it is from a revenue standpoint. And I would suggest you take a look at your company as well and see if there are ways that maybe you could team stack or maximize what it is that you do so you can spend most of your time making money and not dealing with things that may or may not necessarily help you increase your revenue line. Okay, I will now get off my soapbox from a team stack standpoint. Let me give you some audit tips. Because if an audit letter comes into our office, typically it's going to come across my desk and I'm going to discuss it with whoever the tax preparer was, or maybe they'll hand it off and I'll end up dealing with it on their behalf. But there are certain things that I've noticed that the IRS tends to look at. Okay, that doesn't mean that you cannot deduct them. From an audit standpoint, the number one thing is simply that you have support. Support for whatever it is that you bought or how you spent your money. Okay. So how do we do that? We make sure we keep deposits and what we put in our bank account. And the funny thing is, a little trick that the IRS likes to do is they'll say, hey, Joel, let me just take a look at your 2020 bank statements. And then they'll look at all your deposits and see if they make sense. What happens when you get a little birthday present, from, let's say, your mother or father, and they say, ooh, today's been a particularly good year, so I'm going to give my son $500 so he can go out and spend it on a new knife for his kitchen, right? And I go in and I deposit that $500 into my bank account. What does the IRS say when they see that $500 deposit? They go, ooh, that's not a gift, that's income. And I'm going to try to record that as part of our changes to your tax return. Now, while it was a gift, all you have to do is simply note that it was a gift, right? It's simply understanding where your deposits are and how they got there, which means we got to keep records in appropriate time frame. If you were to ask me what I did 2 weeks ago, especially with COVID, all these days are like blending together. I'm trying to always figure out, what day is it? Where am I? What am I doing? And as we kind of are starting to maybe shift a little bit and start to hopefully see a horizon and kind of come out of it, this whole blur of the last year and a half. Think about it, especially when we're in lockdown, every day seemed to just blend together. I didn't know what was what. So trying to think back, what did I do, last March? What was I doing last March? What did I spend that money on last March? It comes in near impossibility. So understanding and keeping proper records in an appropriate time frame, again, going back to you're in charge of your records, knowing how much your money you're making, what may be attributable to the IRS, what do I have to spend, what are my discounts on spending, what am I connecting over, right? So you can see how all these things start to kind of connect with each other and flow to how we're operating our business. So the better I understand my numbers now, the better decisions I'm going to make on how I can spend. And then finally, just be aware that the IRS, if they think you enjoy it, they're going to look at it more closely, right? They're going to look at it more closely. So like an iPad, they may say, oh, you have Netflix on that iPad. Yeah, I have Netflix on that iPad, but I'm using it for my business, right? But they may say, oh, there's an enjoyment factor. Maybe I'll challenge you a little bit on that. Or I'm going to do some traveling to Hawaii. Yeah, but I met with someone for 1 hour during a 2-week stay. Well, they may think you had a little bit too much fun. Therefore, I want to disallow it, right? So they're looking at large dollar items, enjoyable items, and they're going to take a closer examination to those particular things. Doesn't mean we can't deduct them if there's a business purpose. It just simply means that we have to be more, let's say, accurate and detailed with the documentation that we put together for that particular asset or travel or expense, right? So it becomes a documentation standpoint of those particular items. And finally, the last thing I'll say on this particular slide is when it comes to business or hobby, the IRS loves for you to be a hobby because that simply means that you can deduct expenses up to zero and I can never go negative. Okay, which means I never have the opportunity to offset other types of income. All right, let's say my business was actually negative, especially during COVID, but man, was I good on crypto, right? So I sold a bunch of my Bitcoin, made a bunch of money out of this huge loss. Got to make sure that's a business to help offset some of those crypto gains, right? So understanding that the difference between business and hobby becomes important. Let me give you the kind of the global look. What's the main difference? Profit motive. That's it, profit. Motive. Do you have the motive of making money? Are you trying to make money? Because the way you spend will kind of give you a sense of whether or not I'm trying to make money. Am I changing things from year to year? Or am I, if I operated in 2021 and lost $50,000 and went into 2022 saying, I'm going to do everything exactly the same and have a different result and end up at the end of the year losing $50,000 again. And then 2023 rolls around, the same, that's not going to happen, right? So what am I changing? Because if I'm trying to make money, I'm changing things from year to year because my efforts are to make a profit. So keep that in mind when it comes to operating your business. Now, I don't want to make any of you accountants, or you would be accountants, right? But we need to be in charge of our records. So we use technology to help us. There are all kinds of software out there that we can utilize. Quicken, QuickBooks. There are others. Those are kind of maybe the two software applications that are big. You have TaxBot, for example, and other apps that you can utilize that tie into bank statements, credit card statements, and you're swiping back and forth and utilizing that to kind of track the way you're spending money and compiling it into its various categories: office expenses, office supplies, rent, insurance, telephone, utilities, and so forth. So we can use technology to our advantage. When I started with Ernst & Young, I was using a pad, pencil, which this is a pen, I know, pencil, 7-column, going through tracking numbers and so forth. That was horrible. Technology makes things so much easier. Why? So we can, again, utilize technology maybe as one of our team stacks, right? Thereby allowing us to focus more and more on increasing our revenue. Even credit card apps are amazing now. Like I have an Amex business card that I use personally, and Amex has the Amex Spender app. So if I go and swipe that Amex business somewhere, within seconds, that charge appears in my app. They're going to give me a receipt. I'm going to open up the app. I'm going to take a picture. I'm going to attach it to that receipt, and boom, there I have my documentation. I do not want to keep stacks and stacks of paper. I can throw that thing away. And Amex is lovely enough to save that online for 7 years, but I download it and save it to a server, right? So I can utilize apps to my advantage as well. And again, finally, the more up to date and on top of these things, the better off you're going to end up being, the better tax planning that you and I could have as we were, or, tax preparer, but as we're talking, I'm saying you and I, that we could have, if I know exactly where your numbers are and how you've been spending, and then we can actually have a real tax planning session. But use technology to your advantage. Okay, let me just give you a couple quick takeaways. Okay, first of all, let's be smart in the way that we plan. We need to be aware of our tax environment and our partners. Again, the IRS, right? And strategic partners who deals with my phones and my internet, and even dealing with the company here, and how you're kind of focused on and trying different ways of maximizing the efforts that you put forth towards your company. And then understanding how taxes affect your particular business, whether that's real estate, online sales, service organizations, just understanding how those things interconnect, which means talking with your tax preparer or someone to help you out in those particular areas. Finally, let's use some common sense. Okay, let's avoid advice from individuals that you know are giving you bad advice. So if you go talk to your neighbor about tax and he has the biggest house on the block and the fanciest cars and the boats and the side-by-sides, never seems to be at work, and then tell you that he hadn't paid taxes in 5 years, two things are going on there. He's either lying or he's lying, right? So let's use some common sense of where we get our tax advice. And I don't want to say that tax preparers aren't created equal. I think that's an unfair statement. I will say that tax preparers don't always choose to operate in the same areas as others, much like doctors tend to specialize. Tax preparers tend to do the same type of stuff. Maybe someone only wants to deal with real estate, or only wants to deal with small business, or only wants to deal with earned income credit, or with this particular income bracket. I mean, people select and choose the type of clients that they best want to serve. So just understand that. So when you talk to a CPA, just maybe ask them if they're familiar with what it is that you do, because they're probably going to be able to give you better advice because they've probably seen it before. And finally, we're all business owners. If you're a business owner, please act like it, which means doing all the little things that we talked about and being 100% responsible for not only my numbers, but my tax returns and when it comes to operating my business. Okay, we all know that. I'm just reminding you of it as the final takeaway. And then this, I'll just leave this up here. If you want to get in touch with us and you want us to talk about your particular situation, feel free. But mostly, I just wanted to come on here and give you some information that I thought you could utilize and take into your particular business to help you save money. So I'm going to invite Dawn back in. I appreciate the time that you all have given me. It's been wonderful to speak with you. And maybe there's a couple questions out there that I can answer. I'm going to stop sharing my screen here.
Oh, you can leave your screen on there. That's fine. It doesn't matter. So, Joel, a lot of questions about who is TaxHive, and this is new on our stage, and so maybe give a little company background. Yeah. Tell us a little bit about what you do.
So the idea of TaxHive was to kind of take part of what I was doing at Ernst & Young, right? So I actually recruited a bunch of my fellow E&Y members to come work with me, but to kind of take kind of that big four firm mentality and try to bring it to individuals that probably wouldn't otherwise have access to those types of people. Because if you go through Ernst & Young, the overhead rate, you're going to get charged $450 an hour and all those types of things. Most people, if I'm a self-employed individual, I'm making $100,000 a year, don't have access to that. So our idea was, hey, let's take that mentality, let's try to bring it to people to kind of the small business, what I call the kind of heartbeat of our country, and try to help those individuals that may need it. Like I said, that's what kind of fuels me individually. So that was kind of the attitude when we came together, and had spoken to Kevin a little bit about kind of our mentality and what we wanted, and he really liked it, so he kind of jumped on board, and that's how TaxHive came to be.
Okay, and you have an offer for everyone tonight.
Yeah,
is that right?
Yeah, I mean, if you want to talk about your particular tax situation, feel free. You can schedule an appointment with us. We usually think we can save you, or at least find, $10,000 worth of deductions that maybe you weren't aware of. Just through that conversation, we can give you some of those with your particular business. We kind of that's our goal whenever we talk to someone, is at a minimum, right, to have them leave a conversation understanding how they could save more money than when they came into it. But yeah, we're happy to talk to anyone that wants to talk to us. But most important is just putting people in a better tax position based on the short time that I had with you today.
In fact, isn't that Kevin O'Leary's kind of personal guarantee is $10,000 worth of?
I'm gonna find you $10,000 worth of deductions, or I'm gonna pay you $100.
Cool. Yeah. And what does it cost for a consultation with your?
It's nothing. It's just signing it. It's just going in, making an appointment, and that's it. It doesn't cost anything. No.
Well, okay.
They're pretty confident that we can find something for you at a minimum. So that's why Kevin put the offer out there.
Okay. Larry is saying, are you an advanced tax reduction firm?
So, so that's, let me rephrase how I would put that. We are looking at applying the tax rules and regulations that are allowed to you to ensure that you do not overpay in tax, if that makes sense.
Okay.
So if you think about the tax code, for example, the volume, it's enormous, right? But if I were to say the entire tax code is this big, there's only this much allotted to revenue. I mean, revenue is easy when you think about it. How much money comes in? Boom, revenue. Again, we talked briefly about behavioral economics and how we deduct things, and the IRS wants to give you benefit for deducting items. Like if I employ someone, I get to deduct that on my taxes. If I give you a benefit, I get to deduct that on my taxes, right? So all the rest of the tax code deals with deductions, all of it. And so our job as tax preparers then is to look at that global mass of deductions. And so when you say, hey, here's my records, this is how I'm spending money, this is how I'm operating my business, then I want to take all of that massive deductions and I want to apply it to how you are running your business and say, okay, this is how we think we can maximize your deductions based on the rules.
Okay. Are CPAs fiduciaries?
Fiduciaries in what sense? Can I take someone's money? No.
You're right. And you're not investing people's money.
No, I'm not investing people's money. No.
But you have a license and you can lose your license.
But I am licensed. Yes. So I'm licensed to practice. And typically that means I'm licensed to go in front of the IRS on your behalf.
Okay.
And the license also means I've met a certain minimum knowledge requirement in order to practice what it is that I am doing.
And you have continuing education credit.
Our continuing education is like the worst, Don. It's the worst.
All right.
We had 40 hours a whole week a year, 40 hours a year.
So the question about fiduciary, that is really important if you get somebody who's managing your money, who has to act in your benefit.
Right.
But CPAs and accountants,
we don't have access to your money. Even when there are refunds, we don't, that's going to your bank. We're not intermediaries in that aspect.
Okay. Somebody asked, what is PPP and how do I qualify for education loan forgiveness? Well, this is a whole nother webinar, but summarize.
I'll just do it real quick. Unfortunately, the PPP has now ended. So you can't apply for it anymore, but they were loans that were given out to self-employed individuals to help them through the COVID pandemic.
Okay.
Yeah.
And second question, how do I qualify for education loan forgiveness?
So if you obtained one of the PPP, Paycheck Protection Loans, right? Programs, what they call Paycheck Protection Program. If you qualified and received one of those loans, you would go back to the institution that gave it to you. And there are forms that you would fill out and provide to them. And then they would take it to the SBA on your behalf for the forgiveness. So get in contact with where the loan came from.
Question, I'd like to ask if I should own real estate, mobile home park in an LLC or in a trust. And that's really more of an asset protection question.
It is more of an asset protection program question, yes.
And so let me take just a second. And generally, it would be in an LLC managed by a corporation. So and why do we do that? Because the LLC, we want all the tax benefits of owning real estate to flow through to you. So we tax it in something that's a pass-through entity because you want depreciation deductions. You want all the benefits, tax benefits, but you also want it in an entity that nobody can take away from it. And then we want then we separate the active income from the passive income, the management from the actual real estate, so that everything that does come to you through the real estate is passive by nature. And we're looking for all the tax advantages of an LLC taxed as a corporation or a true corporation, depending on where you're at. So I think that's a question maybe for our hotline, Emil. And so give me a hotline number for Protect Wealth is 800-276-1430. Kendall, maybe you can put that it's on our website. It's all over the place, but that's our hotline. And maybe we can answer that one quick.
Yeah, so the only thing I would say from a tax perspective on that is that S corporations make very poor tax holdings for rental real estate.
And picture the old-fashioned mousetrap. We don't want big assets going in. It's kind of like a You can get the asset in, but getting it back out is going to be a little difficult.
That's exactly right.
Be taxed as a partnership, the real estate itself. We want the real estate taxed as a partnership or a disregarded entity. We want the management company taxed either as a C or an S. Would you agree with that?
I would agree with that, yes.
Okay, great. All right. People can get software to do all that. Larry, you're right. Joyce, it's my understanding that if you use the actual method for business use of your vehicle, the IRS can actually make you pay tax for the personal use of your vehicle. Well, that would be true anytime, isn't it?
So anytime we're using something business-wise personally, there are some income aspects that we need to address. Typically, the way that I would suggest that you do something like that is rather than deducting, let's say you drive typically, you're going to utilize your car 50% for business. So if I'm using the actual method, when I go to depreciate or put that asset into use, I'm probably only using 50% of the value of that car, thereby avoiding the other 50% being personal and having some kind of income recapture on the back end, if that makes sense. So I'm actually addressing it from a value perspective when I place it into service of how much business use I think I'm going to have.
And on the other hand, if I've got a vehicle owned by the business, but I'm using it for personal, then I have to keep track of the mileage that way, right?
Exactly. So that's the reverse of what I just said. So if the business owns it, they have the title to it, and if I'm using it personally, then I have some income recapture based on that personal use. Yep.
Great. Okay. Regarding PPP question, I Googled for answer. I'm still curious about education loan forgiveness from Biden. Any thoughts?
On that. So if we're talking about like student loans, for example, that is one of the, remember when I said the wish list is this, and that is part of that, and the actual what we get is this, and whether or not that falls into this, I don't know, but let's just say it is on the table at the moment.
Education loan. The only way that I know right now is work for a nonprofit for 10 years, and then maybe it could.
Yeah.
But there's so much on the table with Biden.
Yeah. So it's hard to know what's going to happen. I mean, at some point, I think when it gets really serious, which I would say more towards the end of the year, then we'll have a better idea of where things stand.
Great. If you have enough deductions to offset rental income, why take additional deductions?
Oh, because you always want to, okay, so good question. But you always want to put in whatever expenses you're actually occurring within that rental operation. So let's say, and I think where you're going with this is, let's say I have 5 rental properties and I am putting in all my expenses, and those 5 rental properties ended up, because of depreciation, having a loss of $28,000, for example. Now we know from a rental income standpoint or loss standpoint, I am limited based on my income to a $25,000 loss per year. My loss was 28. I'm limited to 25. What happens to that other 3? It simply gets pushed over to the next year. So if the next year I only lost 22,000, that 3 comes back into place. And now the next year I'm deducting 23,000. So you never, ever want to leave expenses that can actually be attributed to your rental property off of your tax return, because of the way the carryovers work. Because you're not going to lose the expense. It simply may be carried over and you take advantage the next year.
You know, Joel, I've had students call in on the hotline and say, my accountant told us not to claim depreciation deductions this year on any of my properties because it would be a red flag to the IRS. It would show as a loss, and red flags to the IRS are bad. So if you don't claim it, you're going to lose it.
That's right. You don't okay, let me give you the worst case scenario. Not only if you don't claim it, you're going to lose it, but if you don't claim it and you get audited, the IRS are going to go back and force the depreciation upon you, right? And if it's years past where you can't amend to it, you may end up paying tax on depreciation that you never even accounted for or took place. So what that means is I need to take my depreciation every year, or it can come back to bite me in the most horrible kind of fashion.
And when you go to sell the property, they're going to recapture the depreciation whether you took it or not, aren't they?
That's right. That's exactly right. So let's say I didn't take it for 5 years. and then I start taking it and I sell the property, I'm going to recapture it all those years that I didn't take it, and I'm still paying tax on it.
Justin, take all the deductions you're allowed to take.
That's right.
And then roll them forward to future years if you need to. All right.
That's right.
Okay, we've got a question. If my income comes from business and employment sources, can I still defer $60,000 to solo 401k if the business is making less than 60,000?
No. So there's a formula that actually works out. So I think it's somewhere just shy of $200,000 that you need to make from a self-employment standpoint to maximize that 60 some odd thousand dollars to go into your retirement plan. So it's based off of a percentage based on how much money you actually make. So you need to be probably, just think of it in terms, I like round numbers to make it easy. If I'm over 200 grand, I can max out my 401k plan. If it's less than that, then I'm taking a percentage and it kind of decreases kind of respectfully based on.
And I just use it as straight, I'm simple minded, but
just go 25%. That's basically what
25% up to about $58,000
Yep.
is what you can put
So that,
into it.
yeah, that's how you can look at it too. Yep.
Okay, good. Thank you. All right, Jeannie, can you have a solo 401k when you have rent multiple single dwellings? So maybe talk to them a little bit about the difference between passive and the active income.
Yeah, so passive income is a beautiful thing. It's a thing we all try to achieve and obtain because it's cheap income, right? And when I say cheap income, I don't mean that it's not taxed. I mean that there's no Social Security or self-employment income associated with it, right? So if I'm making money passively, it's coming to me at a lesser rate. But in order for me to contribute to a retirement plan, I need active income, not passive income, which then circled back to what, Don, what you were explaining earlier, kind of the importance of having that management company, which can manage your rental properties, producing active income, thereby allowing you to contribute to your retirement plan. So I need active income to contribute to my retirement plan. Rental real estate doesn't produce it on its own.
Perfect. Thank you. And sometimes that's really hard to figure. How much should I take in salary out of the corporation so that I can contribute to a
right. Yeah.
retirement
account? A little bit of a puzzle, right?
It is.
Sit down with someone, but it's nice to be able to sit down with someone and try to go through it and figure out, okay, this is where you are and this is where you're at. The one nice thing is, depending on what type of corporation it is, I guess you use S corps and C corps, but I would sit down, probably towards that fourth quarter and figure out, do I need to pay myself more in order to be able to contribute more to my retirement plan, again, based on my income levels. But that's part of that fourth quarter planning that should come into play for everyone.
Which, again, take advantage of this. They're offering you a free consult, and they're saying, look, if we can't find $10,000 worth of deductions, we'll give you a $100 bill. Take advantage of that. And sometimes people go, well, I have a really good CPA. You wouldn't mind getting a second opinion on a medical procedure, for heaven's sakes. It's not a bad thing to check on your accountant once in a while and get a second opinion. My feeling. Joel, any comments on that?
Yeah, I mean, I like it just because it gives us an opportunity to teach you more. I mean, honestly, I'm very much kind of a proponent of education and understanding business and how taxes affect your business. And even through that consult, if we can at least give you some additional information, I think it's worth the time.
Yeah, I would hope that everyone takes advantage of that. Okay. I got scammed by someone through hacking my business use computer. Can I get a tax deduction?
So I guess I would have to look more when he said I got scammed, what he means by that. So if you, for example, if I have a business, someone scammed me and paying something that I didn't receive a good back for or a service back for, right? I paid someone something and lost that money, then yes, we do get that as a deduction inside of our business from a scamming perspective. So if it's something other than that, I guess I'd need a little bit more information on what he's referring to.
Okay, I had a property since 2005. He sold it, made $130,000. He hasn't lived in it since 2007, so obviously he can't take the personal residence exemption. I'm wondering if I could not put that money back into real estate, use a 1031 exchange. How much should I save for taxes?
$130,000. So he made 130. So there's
Correct.
okay. So the basis computation is not quite as straightforward as one would like. I don't know if you've been through some of those, but I mean, I hate to get so technical. So I would look at my effective tax rate. I'm going to be taxed on 20% of my gain, right? Because the long-term hold of long-term capital gains is 20%. I'm going to look at my state tax rate. I'm going to add that to it. And I'm going to look at my depreciation. I'm going to look at kind of 25% of that. And I'm going to try to compute those numbers together to give me a rough ballpark. Now, the 20% on that 130 isn't exactly right because it's going to end up being larger than that. But at least that will give you a ballpark. I would go, you could even shoot whoever did your tax return. Say I just sold this property. What's my basis in it? Super easy computation for tax people to do. You can send you back that number, and then you can figure out what your true gain is rather than your cash out gain. I mean, to be safe, if I were to put something aside, I'd put something like, I don't know what state you live in. It's California. It's gonna be a little higher. Here in Utah, it's 5%. I don't know, 35%. You may stock aside 40% just to be safe. And that doesn't mean that's going to be all tax, but from a planning standpoint, because of human nature, again, I always like to talk in tax in terms of behavior. So from a behavioral standpoint, if you think, oh, it's only going to be, $20,000, I'm going to go spend the rest, and then you find out it's $38,000, it's hard to come up with that 18 grand. So I would say set aside, that 40,000 or whatever it could be, get your taxes done in January as quickly as you can of next year so you know what you actually owe, and then kind of go from there.
And a 1031 exchange is an option. Once you moved out of it and you didn't meet the 2 out of 5 year regulation, you've now converted it to an investment property. And yeah, that's it. And the only thing I'd add is if you're in a high income, you'll also add another 3.8 excise tax.
That's right.
To that state and federal. Yeah. So
Yeah.
good. Thank you.
So I'm talking,
Jackie,
it's hard to know exactly what to say. This kind of ballpark around, kind of guessing game.
Good. Jackie is also saying, I work full time as a W-2, have a consulting business. Want to know if for her business, should I put out 20 to 25 aside for taxes? What do you recommend for self-employed?
Yeah, so stuff like that. It depends on how much you make in your W-2. Okay, so remember, Social Security goes up to about $130 some odd $1,000, which is that 15%. So if you have a $100,000 W-2, know that that other 32 is going to have another 15% attached to it. And then beyond that, then you start looking at your effective tax rate. It could be 20%, 23%, 25%. And usually your prior year tax return will give you a good idea of where your effective tax rate is. So I would look at that rate, your state rate, and then where Social Security can kind of plan and come into how much I think I should hold out. Usually, if I say, hey, I make under, 200 grand, and I'm putting in about 100 grand worth of self-employment income. Usually, I'll say 20 plus 15 plus 3, so I would at least be withholding about 38%. Those are ballparks, but it gives you an idea.
Good. Robert, longtime student of ours. Robert, if I own an S Corp, I'm sorry, and it owns a vehicle, it's exclusively used for business, do I have to track mileage?
Do I have to track? Well, the only way to really prove it is by tracking mileage and how you use that vehicle, unfortunately. Right. So I would always kind of get a basic idea of how I'm utilizing that vehicle, because even though the business may own it, so let's say that you come up to me and say, hey, I drove this specifically all for my business. It's owned by the company. My first reaction from an auditor standpoint would be, well, how do I know that? Right? Because the proof is always on our side. I don't know if you drove that for business or not. I don't know if you were driving it to the beach every day to surf, but I don't know unless you show me documentation that tells me that you did. So unfortunately, even when it's owned by the business, yes, it's still a very good idea to track how you're using it.
Really good question and answer. Thank you. How would taxation work if I wanted to use these funds gained to start a LLC for real estate investing? Okay, so we're going back to the 1031 exchange question.
Oh, so if you had that money, even if you started your business, okay, so one, if I went into real estate, the first thing I would do is I would try to earn some kind of money in whatever it was that I was doing. My ability to write off expenses in a new business are largely dependent on my ability to bring in a dollar or bring in revenue. The IRS has different code sections for the startup phase of a business. And then when you start earning money, let's call it the going concern line, and then you start operating underneath that ordinary and necessary rules of my ability to write off money. So if I'm going into real estate, the first thing is I'm going to try to earn money as quickly as I can. If you had $130,000 worth of income and you started making money and had a $130,000 loss, then yes, it's going to flow through and help to offset that amount. Now, I would hope that you wouldn't have a $130,000 loss, kind of generally speaking, but the money that you spent in the business versus the money that you're making in the new business, if you had a loss, that does go to help offset that income that you made.
Okay. Now, we promised everyone we wouldn't go over an hour and a half, and we're coming close to that. So we got a whole bunch more questions. We're going to go as fast as we can, and anything we can't get to, we're going to kind of encourage you to do a tax consult and get these questions answered individually. Is that fair, Joel?
Yeah, that's fair.
Okay. Any favorites when it comes to mileage tracking for smartphones?
So I like TaxBot quite a bit. Is a really good one. MileIQ, I think that's owned by Microsoft, if I'm not mistaken. I think they bought them. MileIQ is strictly mileage tracking. That's another good one.
Okay. If you pay with a personal credit card, can your business checking account reimburse you for that expense?
Yes, but I prefer it the other way, to pay with the business.
And you can always invoice the corporation for personal expenses, but I agree with Joel. I would rather it be paid out of the business. Yeah, good. Okay. Thank you. You're welcome. What's the name of the app you said to track expenses?
Oh, that TaxBot's the expense app. Or if you're from a documentation standpoint, look at your credit cards. They often have apps that allow you to take pictures associated with expenses. And then MileIQ or TaxBot was also one for mileage.
And can you keep it digitally for 7 years?
Yes.
Okay, good.
Digital works just as well, in fact, better, because if you get a receipt, that thing, and live in Arizona in the summer, like right now, that thing's going to fade in about 45 minutes in your car.
Yeah, there you go.
Right.
Okay, will this recording be available? Yes, it will be mailed out to everyone who registered for this webinar. It'll be mailed out. Don't look for it first thing in the morning. It usually takes 24 hours to process and get it back out. But anyone who registered, it'll be available both on our YouTube channel, Protect Wealth Academy, and it will email you the link. So, okay. Do these tactics increase the probability of being audited? Also, would I have to pay more to have you represent us in case of an audit?
So it's not that they would increase your probability of being audited. What increases your probability typically is no revenue and a huge amount of expenses. Okay, they may look at that and say, oh, that looks a little odd, right? Therefore, we're gonna have to go through and we're gonna have to support your expenses. But having revenue and expenses, writing off vehicles, I mean, it's impossible nowadays to operate a business without a cell phone, for example. Impossible. Or the internet, or a computer, or electronic, there are just impossibilities of trying to do business without some of those things. So it's not that it increases your probability. What I would say is red flags is mostly no revenue with a huge amount of expenses. That typically is probably a larger red flag. But there are ways around that using, for example, startup costs and organizational costs and different sections of the tax code to anyways, I won't go into all that, but there are different ways to get around that particular issue.
All right. Mr. Anonymous wants to know, he says he just joined Tax Hive, wants to know how the accountants are assigned.
Sometimes it's based on when we talk to them, personality. I mean, we have a lot. We have a large. Well, we have an age range, right? So we have younger tax professionals, and we have some that are more mature, shall we say? You know,
Okay.
and if someone who's a 25 tech gen, person may not necessarily vibe really well with, let's say, our more mature tax people. They may want someone younger who understands maybe more of their mentality, kind of how they operate, how they view things. So sometimes it's just based on personality. Other times it's really based on what you're doing.
The complexity of the tax.
Are you syndicating? Do you have multifamily? Well, those are going to go to specific people. Are you, so sometimes it depends a lot when we look at a file, or we get a file in and we take a scan, we go, oh, that's probably going to be best with this person.
Okay. What's the difference in taxation between a C Corp and an LLC taxed as a C Corp?
From a taxation standpoint, nothing. They're both going to use the same tax form. They're both going to follow the same tax rules. Legally, they are different companies, and legally, they will have different requirements based on your state, depending if you're an LLC or a corporation, based on minutes and all those types of requirements to keep it up to date. But from a taxation standpoint, you're going to follow the same rules.
On the federal level?
On the federal level, correct.
Sometimes the states like California will charge more for, for your LLC taxed as a C Corp than for a C Corp.
Yeah, by the way, since you brought up California, I just saw an amendment that I think that was either proposed or being passed, that if you're a new company, and I can't remember the start date, that they'll bypass the LLC $800 minimum fee for, I think, 3 years.
Woo woo.
Okay, so I was reading something. I don't have all the facts straight in my head, but if you live in California and you're just starting, go and look up the amendment that was passed that deals with that $800 to get the specifics on it. But just to put that out there.
And Susan, the only other thing I can see is sometimes if you've got a large setup expense, there's what's called a 1244 stock loss, where after 3 years I could come back and wipe out the whole corporation. I can't do that with an LLC because there's no stock. But as long as there's no big setup expenses, I don't see a difference. If you can deduct medical expenses for your family in a C Corp, you can do it out of a LLC tax as a C Corporation. Those are the only two differences I see. And okay. And when is money taxed? Is it taxed before it's deposited or only after it's deposited?
Good question. From an accounting standpoint, it depends. Like that answer? If I'm doing the accrual method accounting, it's taxed when it's earned, not even when it's paid. When I earn it, it's taxed. If I'm doing the cash-based accounting, it's when I receive the cash is when it is taxed. So it does depend a little bit on your accounting method that you choose. And most people, I would assume, listening to this call are cash-based tax.
Most small businesses would set up that way. Is that correct?
Correct. Yeah.
Okay. If I have multiple single dwelling rentals, can I still have a 401k?
Well, no, not this. You have to have active income in order to contribute to that 401k. So, okay. And those rentals are passive.
Okay. I have 3 businesses. My husband uses a company vehicle, which we record 100% use as business. Because we have multiple businesses, do we have to have at least one personal vehicle, or can we both have company business vehicles?
Well, okay, so yes, you can both have company vehicles, but at some point you're going to have to use that vehicle personally, right? So even if the company owns it, the IRS knows that there's no way for you to go to the grocery store and buy some groceries and bring home that beautiful box of Lucky Charms without it being somewhat personal, right? So, I mean, I like to say it this way. You can dance with the bear, but at some point the bear's going to want to stop dancing. So when it comes to the IRS, I would be choosy on how far I try to push that particular type of issue.
Yeah, and just look at the laugh test. Yeah. If you have to laugh while you're filling out the deduction, it's probably not going to go through an audit. Yeah,
pigs get fat, hogs get slaughtered.
There you go. How often can you revise your tax returns, and how far back can you go
3 years.
from the date that it was filed?
3 years from your filing. So if I haven't filed 2020, I can still do 19, 18, and 17. As soon as I file 20, then it's 18, 19, and 20.
Good. Can I use the carryover as a debit account for taxes owed in successive years and continue to carry back the balance?
So it depends on what kind of loss it is, but we can carry it back. And some of those rules have changed with COVID, and I'd have to look up the specifics because they changed some of those net operating loss rules to where we could go back depending on the type of loss that we had. But you can go back, and then what's not used, go back forward with those kind of NOLs.
Should your CPA handle your personal and business taxes? Does it matter?
Makes it easier because you're letting whoever's doing it see your whole picture. I think they can get, honestly, I think they can give you better recommendations or advice that way.
I would agree. Is the EILD loan available yet?
No, not that I'm aware of.
Okay. All right. And we're going to take, I'm sorry, we're not going to get to everything. Oh my gosh. But I encourage you, really, take advantage of that. It's protectwealth.com/tax-hive, right? And
Yes.
it's a free consultation with TaxHive. Nobody's going to twist your arm. No, they're not going to ask you for a credit card. Do they want to do your taxes? Of course they do, but they're very good at what they do. But let them look for and find deductions that you haven't got or maybe have missed. And let's take about 3 more questions here. And then we were going to have to close it down and because I've got 50 plus questions here and I can't get to them all. All right. In regards to operating a residential assisted living business, what are the advantages of using a nonprofit versus a C or an LLC taxed as a C corp?
So if it's I would imagine that most of those type of assisted living facilities are going to be corporations, honestly. Yeah, I would think that, yeah, just from an investment standpoint and kind of how you can treat those moving forward, especially upon expansion and looking for growth money and all those types of things, especially as the baby boom. I mean, I don't want to get into it. It's probably more realistic to do it that way. The thing to remember about nonprofit is sometimes people get confused thinking that if there's leftover money, I can get it, right? Or I can, but that's not how nonprofits work. And when we deal with nonprofits, we deal with what's called fund accounting. And anytime there's excess money, it has to be, from a fund perspective, kind of allocated towards a use that it can go towards in case the nonprofit or whatever shut down. So if it shut down, it had 100 grand, that 100 grand goes to another nonprofit or some type of somewhere else other than yourself. You can't really use those to benefit yourself. And that could be the kind of overriding question of what he was asking. So typically I would say corporations probably are where you would want to go in that aspect.
Okay. Mark's saying, I purchased a house 45 years ago and now we're selling it at 230,000. Any tips on minimizing taxes on it? There might not be any taxes.
Yeah, there might not be any tax. I mean, if you've had it that long, and even if you're single, we're at 250 for kind of the non-tax gain on primary residence. So I would imagine that you're not going to have to pay anything on it.
All right, more or less, how much sales income tax should trigger to convert an LLC from an S corp to a C corp? I don't know that there's a magical number.
No, there's really not. So I would never look at it by saying, oh, if it makes this much, then I can convert. To me, if I was ever going to convert, there has to be a reason, like a specific reason, not, like, it's a small company. I have benefit issues and all kinds of things like that, which may make more sense in a corporation than an S corp, for example. But I don't think there's necessarily a revenue threshold.
Okay. And Susan is asking, who determines what expenses are corn? And Joel, let me give you a little background on that.
What is corn?
Because I've always said that to determine whether something is deductible, it needs to be customary, ordinary, reasonable, and necessary.
Yeah.
And if you follow those guidelines, the IRS will allow the business deduction generally.
Right.
So,
Yeah, that's good.
so is it you that determines whether the expenses,
So
or is it
usually,
the IRS?
yeah, no, usually, well, ultimately, it will be the IRS if it were under audit. However, I would say that would probably be a determination what goes into a tax return between me and a client would be our conversation on what was actually going on. Not only is a CPA's job to try to save you as much money as possible, but a CPA's job is also to keep you out of hot water, right? And people often don't realize that as well.
And
So we
help
have
you
kind of
find the
both.
line between what's
Yes, and where's
customary, ordinary,
what
reasonable,
is
and necessary.
exactly. So that would be discussions that we would have with our clients, and then from there go to the tax return. And if everyone's comfortable and the documentation is there, then it makes it much easier if the IRS ever asks to go to the IRS and say, this is why this was deducted on a tax return. Because believe it or not, people like, CPAs can get fined as well if they let a bunch of stuff knowingly go through on a tax return that was obviously very unwanted. So just keep that in mind as well.
All right. Joel, thank you so much for your time. And for everyone, we didn't get to your questions. I didn't get to any in the chat screen. We still have 18 questions that are open. Please take advantage of this this offer. TaxHive has been very, very generous in offering a free consultation to all of our students. Thank you. And we appreciate TaxHive very much in this. Let them look for things that maybe you've missed. Sit down and ask them questions, and they'll be very open with you. Again, do they want your business? Of course they do. They're very good at what they do. That's why we brought them to the table. But Joel has such great information. Joel, thank you for
Sure. Thanks for having me. I
being here.
appreciate it.
Take advantage of that tonight if you can. Again, it's protectwealth.com/taxhive. Sign up for a consultation and see if they can save you some money on taxes. Thank you, every one of you, for being on the call tonight. We appreciate it. And Joel, so much appreciate your time. Thank you.
You're welcome.
All right. Good night, everyone.